Hey everyone, and welcome back to Invest with Enamul. Today we're tackling a question I get asked all the time. Enamul, how do I even start building my first investment portfolio? If you're feeling overwhelmed by all the options out there, stocks, bonds, crypto, mutual funds, don't worry. By the end of this video, you'll have a clear, actionable roadmap to start your investment journey confidently. Before we dive in, a quick but very important note. Please remember that I am not a financial advisor. All information shared in this video is for educational and informational purposes only. Investing involves risk, and you could lose money. Always consult with a qualified financial professional before making any investment decisions. Your financial situation is unique. So, why bother building an investment portfolio? Simple, to make your money work for you. Sticking your cash under the mattress or just in a savings account means it's losing value to inflation. A smart portfolio helps you reach your financial goals faster, whether that's buying a house, funding your retirement, or achieving financial freedom. It's about more than just saving, it's about growing your wealth strategically. Before you even think about buying your first stock, you need to lay some groundwork. This is crucial. Build an emergency fund. This is 3 to 6 months of living expenses saved in an easily accessible account. It's your financial safety net, so you don't have to sell investments during a downturn. Pay off high-interest debt, credit card debt, payday loans. These have interest rates that will eat away at any investment returns. Tackle these first. Define your goals and timeline. What are you investing for? Retirement in 30 years? A down payment in 5? Your timeline and goals determine your risk tolerance and investment choices. Okay, groundwork done. Now let's dive into the core principles of building your portfolio. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies. This reduces risk. Understand your risk tolerance. How comfortable are you with market ups and downs? Low risk. You prioritize safety and steady, albeit lower returns. Medium risk. You're comfortable with some fluctuations for potentially higher returns. High risk. You're willing to accept significant volatility for potentially much higher growth. Your risk tolerance directly impacts what you invest in. Long-term mindset. Investing is a marathon, not a sprint. Market fluctuations are normal. Focus on your long-term goals and avoid making emotional decisions based on short-term news. For beginners, I recommend focusing on these foundational asset classes: stocks, equities. When you buy a stock, you're buying a small piece of a company. Stocks offer the highest potential for long-term growth but also come with higher volatility. For beginners, instead of individual stocks, consider exchange-traded funds, ETFs, or mutual funds. ETFs. These are like baskets of stocks or bonds that trade on an exchange. They offer instant diversification with low fees. Think of an S&P 500 ETF. It gives you a piece of 500 of the largest US companies. Mutual funds, similar to ETFs, but they are actively managed by a fund manager. They often have higher fees. For beginners, low-cost index ETFs are generally preferred. Bonds, fixed income. When you buy a bond, you're essentially lending money to a government or corporation, and they pay you interest over time. Bonds are generally less volatile than stocks and provide income, making them good for stability and diversification. For beginners, again, bond ETFs are a great way to get diversified exposure without buying individual bonds. Cash equivalents. This includes your emergency fund and any money you need to keep highly liquid. While not an investment for growth, it's a crucial part of your overall financial picture. Now let's look at how you might allocate your money based on your risk tolerance and goals. Remember, these are just examples. 1. Conservative portfolio, lower risk, shorter timeline, or nearing goal. 60% bonds, ETFs. 30% stocks, ETFs. 10% cash. This offers stability and income, suitable for someone closer to retirement or with a shorter-term goal. 1. Moderate portfolio, balanced risk, medium to long-term goals. 60% stocks, ETFs. 35% bonds, ETFs. 5% cash. A popular choice for many, aiming for growth while still having some downside protection. 1. Aggressive portfolio, higher risk, long-term growth, young investor, 80% stocks, ETFs, 15% bonds, ETFs, 5% cash, geared towards maximizing growth over a very long period with higher volatility. A good rule of thumb for stock allocation is the 110 minus your age rule. If you're 30, aim for about 80% in stocks. 110 minus 30 equals 80. It's a starting point, not a strict rule. So, how do you actually do this? Choose a brokerage account. This is where you'll buy and sell your investments. Look for reputable platforms with low fees and user-friendly interfaces. Examples include Interactive Brokers, Vanguard, Fidelity, Schwab, or local options in your region. Open and fund your account. Follow their instructions to set up your account and transfer funds from your bank. Start small and be consistent. You don't need a lot of money to start. Even $50 or $100 a month can make a huge difference over time thanks to dollar cost averaging. Dollar cost averaging means investing a fixed amount regularly, regardless of market ups and downs. This averages out your purchase price over time. Automate your investments. Set up automatic transfers from your bank account to your brokerage account. Out of sight, out of mind, and your money keeps working. Rebalance periodically. Over time, your portfolio's percentages will shift. Once a year, review and adjust your allocations back to your target. A few final crucial reminders. Invest only what you can afford to lose, short term. While investing is for growth, never invest money you might need in the next 2 years. Do your own research. This video is a starting point. Always research specific investments before committing your money. Stay disciplined. Don't panic during market downturns. Stick to your plan. Learning is ongoing. The market is always changing. Keep learning and adapting. Building your first investment portfolio might seem daunting, but by following these steps, you'll be well on your way to achieving your financial goals. If this video helped you, please hit that like button, leave a comment with your biggest takeaway, and of course subscribe to Invest with Enamul for more practical investing advice. Thanks for watching, and I'll see you in the next video. Happy investing!